What's up? Happy Memorial Day, everybody. So I put together a spreadsheet on pricing options. This is my spreadsheet, and I think this is a simple way to convey options, as simple as I could come up with. Options are actually very, very simple and straightforward, but understanding the nuances of options can be really confusing. So the way I think about it is, assuming you're over 18, you probably drive a car. Do you think it's complex and difficult to drive a car? Probably not. Maybe the first week or so, but it's pretty simple, right? It doesn't take much knowledge and expertise. So I think of options as like driving a car. It's very, very simple, but building a car is not simple. Can you build a car from scratch? That's probably pretty complex. And even if you're a mechanic, you might have a hard time building a car from scratch. So that's like options. It's very, very simple, the basic options. And that's what we're going to do in this video, to show you a basic call option. But it can get super complex. Just like buying a stock. Isn't it easy to buy a stock? You go to a broker and you buy it. But if I ask you, now, instead of just buying it, I want you to value it and explain your valuation and why you think that scenario will work out, and show me other scenarios where it may not work out as you predict, but there's more extreme cases like the second or third standard deviation. That would probably be a little hard to do, right? Because a lot of people might have difficulties trying to explain why they buy a stock. They might say something, or the company's good, or the stock price was $200 last year, now it's $100 this year, so it's a good value. That's how some people value stocks. Nothing wrong with that. Other people, like, I will go through their financial statements and explain why I buy it. But that doesn't mean I make more money than the average person just because I could read financials. So high level, and then I'll show you my spreadsheet. This is my spreadsheet. So high level, I just want to explain, and please comment so I know people are here, because I always get paranoid that no one's listening to me. I'm just talking to myself. So call options, we're just going to do call options. We're not going to do put options. Next video, I can do puts. It's pretty much the same thing, just opposite. So call options. And we're just going to be buying options, not selling options. So call options give the buyer, who's us, the right, but not the obligation. So we don't have to exercise the option contract. So it gives us the right to purchase a stock at a certain price by a certain date. The strike price. So I think the best thing options are designed for is for hedging. I think if you hedge, meaning say you own a lot of a stock. What's up, Javier? I don't know what you mean. Nice way to resume call options. I think the best way to do options is hedging, because if you have a lot into a stock, say for instance, you worked at a company, right? And you had a senior position, and then you quit the company, you're retired, or maybe you're a new company, but you have half your portfolio is in this company stock. And instead of selling it, you want to hedge yourself, because the stock goes down a lot. That's going to really affect your retirement. So what you do is you hedge yourself. You maybe buy puts or sell calls. I mean, you could short the stock outright, but I think the best way you can use options is hedging. Some people do it as a gamble, kind of like a speculation, like playing the lottery. There's really no logic to playing the lottery. You can't like outwit the lottery. You could try to outwit blackjack, and I'd love to talk about that because I think about that a lot. I used to do it all the time. But you can try to, Victor, what's up? I mean, it's literally like you are describing it. It took me a few years. Oh, okay. I see, Javier. Okay, got you. I thought you meant for my last video. I thought you were, but I see what you're saying. But I don't think of options as an investment. I think of it as more of a wager, a bet, speculation. And of course, you can make smarter or less smarter wages. You can go to a casino and you could count cards like I used to do. And then you're increasing your odds of winning. Or you can just go to a casino and play slots and probably lose all your money because you generally won't win much in slots. So these are just smarter options. Just like buying a stock, you can invest in a stock that you do a lot of research on. And if you want to know what a derivative is, it's an option. It's when you have exposure to something indirectly. Can you explain the difference between shorting and put? I don't understand the differences. I know shorting is extremely okay. Short and long. I'm glad I did not short NVIDIA. I know, right? I'm still thinking about it though. So these are kind of common terminology. If you invest, you might hear the word I'm short this, I'm long this. So short in simple terms means you think something will go down, a security. We'll just say stocks because that's pretty much what we're going to talk about it. And when you long something, you think it's going to go up. So how do you long something? How do you short something? Well, the most common way to long something is just to buy the stock. So if you're buying the stock, you're longing it. You're betting it's going to go up. You hope it goes up. How else can you long a stock? I mean, there's a million ways. There are literally a million ways. You can buy a call. You can sell a put. These are the most common, straightforward ways, and we'll talk about that. But how do you short? You can buy stock short. You need margin to do this. That's the only thing that I hate about this is that you can't just do it outright. You have to use margin. So you have to pay like an interest rate. So when you buy stock short, what's NVIDIA? I think it's like 1050, let's just say. So I'd say it's 1050. I did a video on buying. I did actually buy one. I shorted one share of Tesla in the video. It's in my E-Trade account. I reversed it right away, so I lost like $20 in like fees or whatever. I didn't keep it on there. But if you buy a share of NVIDIA short, that means like it's 1,050 today. So your brokerage account, you would see 1,050 in your brokerage account. You get that money right away. And as NVIDIA goes up and up and up, you lose money. And as NVIDIA goes down and down and down, you make money. So let's just say the most extreme situation, which I know this wouldn't happen. So you bought one share of NVIDIA short. So you would receive 1,050 in your brokerage account. That's cash. You can do whatever you want with the cash. And say NVIDIA goes to zero. The most extreme situation, it goes to zero. Then it's done. Then you keep the 1,050. You don't have to ever pay it back because it's zero. The company went bankrupt. That's a perfect situation when you short something, it goes zero. But what happens if in a few months from now, it goes from 1,050? Let's just pick 1,000, so it's just easier numbers. So you bought a stock short NVIDIA for $1,000. So you have $1,000 in your brokerage account. 3 months later, it's $1,500. So you have to replace that stock you bought. You bought one, you shorted one share, so you have to replace it. So you have to buy NVIDIA in open market for $1,500 and replace the one you borrowed. So you would lose $500 on the trade. But that gets more involved. I'm trying to keep it high level so I don't lose too many viewers, because I get too much in the weeds here. And then I did a video on, actually I posted a video about 5 or 6 years ago. I got scammed out of $27,000. It's, you see on scrolling on the bottom of the screen, if you want to watch that video, it's on my old YouTube channel. I used to scratch off lotto tickets on my old YouTube channel, but then it was getting too expensive to keep buying the tickets. But if you want to see that video, it's just real. It's me. I got. So anyway, so if you want to short, you can buy a stock short, right? You can sell your stock, because when you sell a stock, that's shorting it. You're betting it's going to go down, so you're just taking your money back. You can sell a call. You can buy a put. But the list could go on and on. Like, say, for instance, you loved NVIDIA and I hated NVIDIA. We can do like a contract between each other. I would say to you, listen, if NVIDIA hits $2,000 this year, I'll give you $1,000. If NVIDIA hits 500, you give me $1,000. So that's another way to short it or long it, depending on which side of this trade you're on. This is a derivative because we're not actually buying NVIDIA stock; we're referencing it. I saw some NES about some news about NVIDIA is looking. Yeah, they're going to split a 10-for-1 split. Generally, a stock split is more attractive to investors because the stock price goes down, so it's more appealing because people can afford it. And I get it; you can buy fractional shares these days, but people like to buy a share or multiple shares, and if that's why, like with Berkshire, one share is so expensive, like $600,000 for one share. So people, and they do have the B shares, but people generally want, like, psychologically, they want to own a lot of shares of a stock. If they own like 10,000 shares of a stock, even if the stock is $1, they feel like they own a lot of the company, even though it's the same exact thing as owning one share of a stock where this one share costs 10,000. It's just psychologically people like it better because it's cheaper, but there's no fundamental benefit, and there's no it makes no difference if a company splits or not, or a reverse split or not. It makes no difference on the company's core business. The only difference is it's psychologically people in the market. A reverse split, people think the company's struggling, and because when you do a reverse split, people pretty much are struggling because their stock price is getting below $1. But I'll just show you the Excel file, and if you're a member of my channel, and you could be a member for as low as as low as 99 cents. Well, let me if you're a member, just email me because I got rid of Patreon. Just email me if you remember, and I'll send you this Excel file. I'll send you anything. I'll send you $1 million. Just please be a member. This is my email. Okay. So this is as simple as I can make it. And this is my own Excel file. So I did all the, so this is how I think about options, and we can get as abstract and complex as you want. But this is a pretty basic way. So now you know how options work, the high level. How could that affect the options? Options are not affected. Nothing gets affected by a stock split. Nothing, except psychologically, people feel it's a more valuable company, so they buy it. They buy it because it's cheaper and it's more affordable. I'm going to just do Intel, options on Intel, because the stock is kind of beaten up, and I think that could be a good one. Victor, thank you. I hope you didn't feel obligated to give me a sticker, because I gave you one. But that's very nice of you. You can't see the whole email. You can't see the email? All right, because my face. But you can look at any video. Every single video has this email. Just email me. Please email me. I'm so lonely. I need friends. Just email me. I'll give you whatever you want. I'll give you $1 million. Okay. And this is all free information. You can get all this information. So this is the spreadsheet. I would go to Yahoo Finance. I actually like Yahoo Finance better than pretty much better than any site that I pay money for. I'd rather go to Yahoo Finance, which is free. Okay, so you go to Yahoo Finance, any stock you want. We're going to do Intel as an example, but we'll do other ones as I go through this video. So what are they trading at today? 30.72. We're not going to value the company. We're not going to look at the market cap or anything like that. We're not going to look at the financial statements. We could, but we're not going to. I'm going to show you how to value options. Just straightforward. Okay. The predicted price is up to you, your discretion. Now let's go into the options tab. This is free. I don't pay for Yahoo Finance, so you can use it too. So you just go to options. This shows you the options activity. And when you buy options or sell options, make sure you look at the date. I made a lot of mistakes when I did options. I remember once I ended up buying puts instead of calls. I went to the wrong screen. I ended up, or I bought the wrong date, or I forgot to exercise my option and it expired worthless. That's how you learn. You make these mistakes. You send me crypto, send me Amazon gift cards, and then I could send you a picture of a box with gold bars in it. I'll send you that picture. And if you send me an Amazon gift card, I could send you a gold bar, which is like $100,000 in the mail. Logically, why do I need that $500 to send you the gold bar, right? But I need the $500 just for to get out of the hospital, right? I'm in the hospital. I was on an oil rig. I've been watching this YouTube channel, Catfished, and all these people in these romance scams. It's always the same thing. Okay, so you could pick whatever expiration date you want, and I don't want to explain how expiration dates are the options price is highly influenced by the expiration date. I'll explain that later. I think if you see how it works, I'm just going to go out a few months to December 20th. You want to give yourself some breathing room. December 20th. That means we have to exercise the option contract on December 20th or before. We can't do it. We can't do it after. And you see these fields up here, these column headings, contract name, strike, last price, very important information. It's up here on top here. These first two columns I really don't care about, so I made it really small, but you could ignore it. You probably, if you buy and call options, you probably don't want to buy the stuff in the blue. It's already in the money, meaning it's already, you can exercise the option right now. If you buy it, it's lower than a stock price. So when you buy calls, you're longing the stock, right? You're expecting the stock to go up. If you think that stock was going to go down, you would sell calls or buy puts. But we're longing it. So it doesn't make sense to buy it, to have a strike price that's less than a price today. And what's Intel's price today? $30.72. So we have to buy call options above that price. Long-dated options are called leaps. Is that 2 years out, a leap, the definition? So just copy. You can go as far out as you want. You can go to 70, 44. Just copy as many rows as you want. I went up to 45 on my file. So just copy this, Control C, and then paste it in here, which I already did. So that's the information, right? That's all the information to buy options. Going to send you. Hey Neil, what's up? You were on Victor's call. Neil, did you find me through Victor, or did you find Victor through me? I think you found Victor through me, right? Because I don't think Victor had a channel. I think you've been around for a while, so I don't think Victor had a channel. So I'm gonna do the $40 one. Let me highlight it a different color. Which makes it impossible to see. Okay, so we're going to do the $40 strike. So I just said a $40 call. That's just another way to say it. So that means it has to break through $40 for us to make money on this option contract. Okay, so $40 call. So you see the exercise. I did $40 right here. That's our exercise price. How much do we pay for the contract? It's called the premium, the option premium. It's just a formula I did, so you don't even have to. You do have to fill in the 40. I'm going to make this a different color. So this is a formula, so you don't have to touch it. I'll explain how the formula works. Generally, when you buy an option, you have to pay a premium. And if you look at the option, the bid is the last premium paid for this option. So for December 20th, 2024 call options for Intel, at a $40 strike, the last person that bought it, they bid 84 cents. And the last person that sold it, they asked for 107. The ask is always higher because the person selling it always wants more money. It's the same thing with a stock. Let's see if you see with Intel, the last bid was somebody who wanted to buy Intel for $30.70. And the last ask was somebody who wanted to sell it for $30.78, because the ask is the person selling it. The person selling it is always higher than the person buying it, because you always want to buy it for as little as possible, and you always want to sell it for as much as possible. So, and you see with common stocks, the bid-ask spread is usually really, really tight. It's 8 cents. The bid is $30.70. The ask is $30.78. So it's only 8 cents different. Sometimes it's like a penny difference, because the smaller the spread, the more liquid the investment is. The wider the spread, the less liquid. So you might see a bid-ask spread of 8 cents for a stock, but if you wanted to buy your neighbor's home, he may be asking $1 million and you're offering $800K. It's a big difference, right? $200,000, because a home is not nearly as liquid as a stock. So this is just a good thing to think about. Whenever you see wide spreads, it's a volatile market, or the investment is volatile. It's a liquid. The wider the spread, the more opportunity there is for you for arbitrage or to make a profit. Also, there are more opportunity there is for you to lose a lot of money and make a mistake. So we don't have, okay. So how much do we pay for this option? Well, the last person bid 84 cents. So generally it's between the bid-ask spread. Usually that's a good, you could bid 84 cents, but you might not get anybody to sell it to you. And if it goes up a lot until like over the next week, you may lose out. It may end up going from 84 cents to bid to $1.50 if it keeps going up. So a good rule of thumb, I think, is take the middle of the two, the bid-ask spread. You'll probably get action on that. So I did the average. I took the sum of these two numbers, 84 and 107. I took the sum. I just did a VLOOKUP. And I took the sum divided by 2, so the average. If you really wanted to buy it and you don't want to risk losing out, then you can just do $1.07. You're guaranteed somebody will sell it to you for $1.07. But you don't want to overpay. There's no reason to overpay. So if you really, really want it, just do $1 or something. But if you do like close to 84 cents, you probably won't get anybody sell it to you. Or if you do under 84 cents, you definitely won't get anybody sell it to you. But if you want to get into options, do covered calls. That's a good way to start to learn about it. Covered calls is when you sell call options. But you want to own the stock if you sell it. Because selling uncovered calls is the riskiest investment. Because when you sell an uncovered call, you're giving someone the option to buy a stock from you, and the stock in theory could go up a lot into infinity. A stock can't go down below 0, so there's a cap on the bottom, but the cap on the top is infinity. Of course, it can't go to infinity, but it could go up a ton, like GameStop did. Okay. So we're going to pay somebody 96 cents for the option to buy Intel for $40. Is that clear? But you're not. But it's 96 cents for one share. And remember, an option contract is 100 shares. One option contract is equal to 100 shares. So you take the 96 cents times 100. So that's the premium you pay. You pay someone 96 bucks for the option to buy Intel for $40 on or before 12/20. So if it never hits 40, you may not exercise the option. And I understand that you don't have to wait till it hits $40. There's value in the option as it gets closer to $40. So you can sell the option in the open market. But I don't want to get into that. On another video we will, but I think it gets a little more confusing. I just want to keep it as simple as possible to explain what options are. And I'll be right back in 2 minutes. Okay. Okay, so everybody with me? We bought a $40 call option on Intel, and we paid $96 for this option. So the most we can lose is $46. So that's why buying calls is a great way to learn about options, because it's pretty cheap. You need reasons to buy another insider knowledge. The more you learn, the better. So there's we could only lose $96, which is pretty unlikely we're going to lose, but you can make a lot of money. So let's just say, so this is the scenario of buying just one option contract. I'm going to hide this for now so it's not confusing. So if you buy one option contract on Intel, it's only cost $96. And you control 100 shares, right? Alternatively, you can just buy 100 shares of Intel because it's $30.72 today. So you can spend $3,072 and buy 100 shares. But that's expensive, right? Now, let's just say it's good. I'm actually learning a lot. I'm surprised I like it. I'm really learning about real estate development. It's really interesting. I've been there 5 weeks. Yeah, I'm learning about how to funding, of course, because I'm the controller. So I'm obviously understand the financial part of it, but I'm learning how to find land, how to, get the engineers, the contracts in place, how to source for different, there's a lot of things to do, not just buying and constructing it. You have to do a lot of civil engineer to make sure the dirt is is strong enough to hold the building, or if it's not, then you have to kind of like build things in the earth or have certain so if you don't have $3,072 to spend for 100 shares of Intel, you can just buy one option contract. Now let's just say and we're not going to trade the option in the open market. And I know a lot of people say, well, because I would always trade. I never really buy the stock, but I think this is a straightforward way to explain it. So that means we would not exercise the option if the price was $38, right? Because why would we buy it for $40 when we could just buy it for $38 if it went up to $38? So we would never exercise the option unless it broke through 40. And let's just say it between now and December 20th, the highest it ever gets is 40. That means we just lose $96, 100% loss. But if it hit 40 on December 20th, we would have made $928 if we bought the shares outright. So in this scenario, it would have been better to buy it outright, and we would have made a 30% return on our investment. We invested $3,000, we made $900, a 30% return. Okay. Of course, it's less risk, but what if the stock goes down to like 20? So I got to fix this formula. This is good. I did this because I didn't. If this is less than 0, then this, else this. Okay. Got to fix the formula so it made sense. So if the stock, you buy it, I'm saying if you bought the 100 shares, right, at $30.72, and it went down to $39, right? Not went down, but went to $39, hit 39, say by 12/20. You would have made $828. So you would have had a 27% return. The option, you would have just lost your $96 because it never hit 40. So you would never exercise the option. So it's like, why don't you just buy the stock? Why doesn't anybody ever trade options? Because what if it went to like from $30.72? What if you bought it, the 100 shares, and it went to 25? You lost now $572. You paid $30.72. It's down to $2,500. So you lost $572. A lot worse than losing $96. Even though it's 100% loss, it's only $96. You didn't exercise the option. So that's why it's less risky to buy options if it goes down, because you only lose your premium. And if it goes down even further to $10, you lose $2,000. It's a lot of money. Now let's do the other way. Let's show you. Say it goes to 41 on December 19th or December 20th. It goes to $41. Then you would exercise the option. You would buy it for $4,000 because that's your contract. That's your agreement when you purchase the option. You pay this premium, so you have the ability to buy it for $40 a share. You can only buy 100 shares because you bought one option contract. Then you immediately turn around and sell it in the open market for $41 because that's the price in today. So you sell it for $4,100. You profit $100 from the stock sale. But you did pay that premium initially of $96. So you made $5. That's your profit for this whole investment, which is a 5% return. You would have been a lot better off just buying it outright. You would have had a 33% profit. Even better is a $1,000 return. Is that clear? Does that make sense? And email me, and you can have this Excel file, and you can plug in the numbers yourself. Assuming you're a member, you got to be a member. It's only $1 a month, the lowest membership, 99 cents. Now let's pretend it goes higher. Let's say on September 3rd, there's just some really big news that Intel is now competing with NVIDIA, and Intel goes to the moon. It goes to like $80. So now you invested $96, but you have the option to buy Intel for $40 a share, even though it's trading at 80. So you buy it, you exercise the option, you give $4,000 to the person who sold you the option. They give you 100 shares of Intel, and then you turn around and sell it in the open market for $8,000. Your profit is $4,000. You only invested $96. So that profit after the premium is $3,900. So it's a 4,000% profit. You 40x your investment. If you bought 100 shares outright today of Intel, you would have paid $3,000. And say the price hit 80, you can sell it for $8,000. You would have profited more by just buying the stock. But your profit is only 160%. Why is your profit percent? Why is it so much lower? Because you only had to invest $96 to profit $4,000. So you might think, why do you buy options? Because you could make more money with buying a stock outright. This is assuming you just buy one contract. What if you bought 100 contracts? Dollars to control 100 contracts. And 100 contracts is 10,000 shares of Intel stock. So instead of 4,000, the cost to buy the shares is 400,000. You could sell it for 800,000. Look how much money you made. $400,000 from a $9,500 investment. Same return. You're still going to have a 4,000x return, a 40x return. But instead of making $5,000, you made $390,000. That's called leverage. That's how you lever up your investment and make really big money. Because say on the flip side, you could have bought 10,000 shares of Intel. You could have done that. But who has, I'll show you. That's assuming you have to hell. You'd have to drop $300,000 into Intel. And if it went up to 80, you would be killing it. You would make a massive return. But who has $300K to drop into Intel And even if you had it, who would do that? It's very, risky and expensive. It's much cheaper to just spend $9,500 and control 10,000 shares. That's why you can really lever up with options. Okay, now I'll bring it back. So the purpose of this spreadsheet is, now let's combine it with analyst estimates. So on Simply Wall Street, you can see what analysts predict the stock price will be. You could even see it on Yahoo Finance. They have the 1 year target, 38.50. But if you are a member of these financial websites, you might see like analyst predictions. I'll show you on Simply Wall Street. So I'm going to show you how to combine it with my so a lot of websites have analyst projections. And not that the analysts really know anything, but if you want to just if you want to just use their projections and then compare it to buying the stock outright, what if you use options and the analysts were correct? Because obviously you're going to use options because it's too expensive to you can't drop like $1 million on a stock, but you could control $1 million of shares for only a few thousand. So like Simply Wall Street, it has all these analyst targets. This is like, it changes over time. Like in 2023, the analyst target was $52. The 1 year target, when it was 44. And you can see over time where the analyst target, whoever it moves to. So let's say the analyst target, I just took a screenshot from Simply Wall Street. This is December 2024. This is when we expect the, this is our kind of like our option expiration date, December 20th. So December 2024, the low is 17. So maybe one analyst thinks it'll be $17 by December, and another analyst thinks it'll be 68 by December. And you can find different analysts. 1768. So there you go. So if you trust the analysts, say the analysts are 100% correct, which they aren't, but even if they're 10% correct, even if you find analysts that can predict the stock price, even a 10% of the time, you can make a lot of money with options because you don't have to be right that often. Even if you're right 1 out of 20 times with options, you can make money. So let's say the analyst, let's say you find, like, I'm just taking the average of the high and low, the 68 and 17. So the average is 42.50. So if it does hit that 42.50, and you buy 100 contracts at 40, you make $15,000. That's your profit after the premium. You would make $25,000 profit on the sale. But let's do different strike prices. This is the purpose of this model. You can do different strike prices. So 42.50, let's look for something else. You can do obviously anything above 31. So So your return is 162% at the $40 strike price if it hits 42.50. Let's do a different strike price. Let's do 35. Look at your percent profit. Now it's 255%. So you just keep playing around with the numbers. Look for the highest. Like start with 31, 219%. You're looking for the highest percent. And it doesn't matter how much money it costs. Once you find the highest percentage, then you can buy 5 contracts, 10 contracts, 100 contracts. Exercise price. Let's do 219%. Let's do 32. 228%. 254%. See, it's just calculating the bid ask, which we know these are the real bid ask spreads in the market. $34, that's 263%. Let's keep going. 35. So 34 is the best. 36. What was 34? 263. And you could write this down. And email me if you want this model. Option premium. Well, give me a stock. What's the latest on MPW after proving its balance sheet? Give me a stock and I'll do the option. Same exact thing. I'll show you how to price the options. Any stock. Does anybody want to see? And I'll show you how to go through the process. Some stocks you won't make much money. Some stocks there's not much activity. It's kind of like your neighbor's home. If they're not selling the home, you can't buy it. I guess you can offer them more money, but it's the same thing as trying to buy options on certain stocks. If nobody's selling options, you can't really buy them. So throw out a ticker, and I'll show you the process with a different ticker and how it works. What do you guys think? So we're trying to look for the highest percentage. Any tickers? Any because these are the prices in the options market. These are real prices. So you can ship. Why would you pick ship? Why would you pick, out of all stocks, why would you pick ship? It could be any stock, just not ship. I'm joking. You could pick ship. Trying to be funny. It's like your teacher. Ask me any question. Then or your parents, and you ask them a question. Why do you always ask me this question? Like you can never win. I was joking. It's fine. 1201. So we're not doing any analysis. We're just pricing the option. That's the beauty. We don't care if it's 240 million, 240 billion. We know the price. That's all we need to know is the price. Now let's look at the options chain. And we need options activity, obviously. If there's no activity, you see there's less dates because it's not as active. But that's fine. We'll do November. Let's do November. You want a little breathing room. There's only 2 contracts. And there's no bid activity. Nobody's even bidding on these 2 contracts. We have to do in the money. Let's see. let's pick a different date, see if there's any activity. Nobody's bidding. See, nobody's even looking to buy. But it's fine. It doesn't matter. We can still do this process. Okay, so we're going to do, we have to just copy from Yahoo Finance. You want to copy the calls, not puts. Next video, we'll do puts. And then just put into the spreadsheet. Let's get rid of the Intel on the bottom here. So there's only, you can buy options in the money. The thing is, you might have to pay a higher premium. So let's let's get the analyst projections. And that's a beautiful thing about options is it's illiquid. So you can make a lot of money on options. It's like buying a home. You can make a lot of, if you know what you're doing. Obviously, you need to know what you're doing. You could lose a ton of money if you don't. But if you're really, really shrewd and you understand how to buy real estate, you can make a ton of money because it's illiquid. You could find a lot of really, really cheap deals. It's just you have to know what you're doing, and that's a problem with most things. Is like people don't understand the nuances. Like when you buy a home, there's a lot of other things. That's not just buying and then selling it. You might have to fix something on it. There might be a lot of mold that you don't know about. So you have to, if you really understand it well, the home you're buying, you can make a ton of money. Same thing with options. That's a great thing. Let's get the valuation. Simply Wall Street's at 78 cents. That won't work. Okay, we have 4 analyst projections. Let's go. I hit data so I could visually see it. Let's get the, and you can go to different websites. If there's a website you really trust, like there's an analyst that seems to do a good job at predicting the price. Even, like I said, they only need to get it right like 10% of the time for you to make money in options because there's so much leverage. So we're doing, we're doing September, right? 9. We don't need the exact date, but, oh no, 10/18. Okay, 10/18. So the analyst projections for 10/18 are as low as $5. Oh no, here. Oh, that's the today's price. Okay, so it's between 7 and 14. That's the analyst projections. Let's do the 14. That's the future price. Now we have to get what's the strike price? So what's a strike price? It has to be one of these numbers: 2, 4, 7, 9, 10, 11, 12. And we have to go into money, unfortunately, on this one. Let's do the strike price. It's 1201. Let's pretend the strike price, we'll do 13. So if it does hit 13, I mean, if this analyst predicted it right, the $14 analyst, if it does hit 14, and we're buying the $13 strike, right? We make a 21% return on our investment. which is better than if this is greater than this, then yes. No. I'll make it even easier. So it's just it says yes or no. So should you buy the option? Should you buy the $13 option? Yes, because your return is higher than buying it outright. How about the $14 option? No. Because with the $14 option, that's your predicted stock price, $14. So if it hits our prediction, we're going to lose money because that's our strike. It has to break through $14. Let's do the $9 one. That's a 37% return. So for the $9, we have to pay a premium of $365, pretty high premium, right? To control one option contract. And if we do that and it hits 14, the predicted price, we'll make $135 after the premium, which isn't a lot. It's 37% return. But if you buy 100 contracts, so this is a bit tight. There's not much room. The reason they sell it in the money is because like if the stock is trading at $50 today, right? And if I do a strike of $60, right? Then it has to go up $10 in order to make money, right? It has to hit 60. So maybe I spend like, I don't know, $1,000 to have this option to buy it at 60. But if the strike is 40, right? It's already in the money. So that means I could immediately buy the stock at $40 a share and sell in the open market. So I can immediately make $1,000 profit, right? So why would anybody sell it in the money? Because how much would the premium be for the option? It would probably be like $1,500 to buy it at 40. Because the premium is so high. That's why you would sell it in the money. Like obviously, it would have to be if this was a scenario. The current stock price is 50 and the strike is 40. That means I could buy 100 shares at $40. So the minimum the premium would be $1,000. It would have to be at least $1,000, probably like more, like $1,100, $1,200. It's just the premium is higher, so you wouldn't make any money by buying it right away. You would still have to wait for the stock. It would literally have to go up to like $60 just to break even on the option. So this is how you do it. It's just that easy. I don't know if that's super clear or confusing. Let's try Zim. There might be more activity on Zim. So it's 2104. And let's go to the options chain. We'll do the October. There's only 3 out of the money. Three. Let's see what the analyst projection is. Simply Wall Street's 24. So October 18th, let's see the analyst. October 2024. So the high low. So somebody thinks it'll hit 16 by October. Let's just pretend that's correct. Prediction of 16. So now we have to pick a strike, one of these 4. But they're all above 16. So let's just pretend we found an analyst that said 38. Let's pick 30. Okay, so if we do the $30 strike price, we have to pay $1 premium, because you see that the bid is 87 cents, the ask is 112, so the average of those two is $1. So it only costs us $100 for one contract. If we bought 100 contracts, it would cost us almost 10 grand. And if our predicted price came true, it hit $38 at some point, we would make $70,000 profit after the premium. So 700% return, not bad, right? 1 second, I'm gonna get some tea. That's too much talking. So that's why I'm saying it's not easy. It's not a guaranteed home run. But if you do a lot of research and you identify a stock, say Zim, and you're like, I'm pretty sure it's going to hit like 38. You look at like shipping rates, you look at like supply demand, you look at the historical stock price, and you look at other things, and you're like, and like I said, you only have to get it right 10% of the time, because look how much money you make. You have to lay down 10 grand, but even if you get this wrong 3 times, you lay down 10 grand 3 times, 30 grand out the door. But if you hit it once, 70 grand. But what if you get even luckier? What if it instead of it going to 38, which you thought it would, it goes to 48? you make $170,000. Still laying out 10 grand. So that would pay for 16 times you got it wrong. Where if you just bought the stock outright, you would only make $2,700, which is great, 128% return, but it's not life-changing like this. So you email me if you want this file. So I didn't want to get too deep into other like straddles and like what are the others? But let me know, are there other options? We could do puts too. But I guess we could do puts. I think I have to change the formulas around, so I don't want to get into puts. But I could fix the formulas. What's another stock? The thing is, you don't want to, like Roaring Kitty did, you want to buy, like he bought GameStop before other people bought it. So he paid like hardly anything for the option contract. Like you see the bid-ask spread, like for the $35 calls, it's 40 cents to 55 cents. Like his bid-ask spread was probably like a penny because nobody else was buying it. It was only him. So a lot of people would sell him the options because nobody else is buying it. Why would they thought he's just throwing away money? So he put $50,000 into GameStop options. He turned it to almost 50 million. But only with options you could do that. And you can't do it when everybody else is doing it. Like you can't do NVIDIA options because everybody else is doing it. You got to do it before everybody figures it out. Well, covered calls, what I'm doing is I'm buying call options. But if you sell call options, like you're on the other side of this trade and you own the stock, you want to own the stock. So if you sold these SIM options, the $30 strike price, you have to own the stock for it to be called a covered call. You can do uncovered calls. But yeah, let's do it. Let's see the options chain on NVIDIA. It's probably so expensive. That's the thing. When it gets so expensive, the premiums, you're probably better off just buying the stock outright because you can't really make any money in the options. Look at this option chain. Look how much activity it has. It's so big compared to like Zim and let's see if we can go far. So $1,500, and look how much activity. There's activity at 1,500. Okay. So we'll do NVIDIA. Wait 1 second, my TV. Okay. I thought this would be a popular stream. I guess I can't make anything. I guess you got to be all fun and like make noises and stuff. So how much is NVIDIA? 1068, 1065? It's expensive, right? So if so we'll do the 1500 strike. And if it hits 1600, like if we bought 100 shares, it's $106,000. If it hits 1600, that's up to 160. So we made $50,000. Or you can buy 100 contracts for $400,000. It's too much money, right? Let's go deeper. Let's go to the last one, 1780. And if it hits 2000. So if we bought the $1,780 strike price, we bought 100 contracts. It would cost us $100,000. See, you see how high the premium is? It almost never makes it worth it. But if it hits $2,000, it doubles in price to 5.5 trillion market cap. Then you make $2 million. Or you can just buy 100 shares and make $90,000. So does it make it more straightforward now, options? I'm not sure. The point of options is you probably shouldn't buy them because it's almost impossible to make money. Unless you have inside information or you get really, really lucky. Because even if you predict NVIDIA stock goes up a lot, it has to go up so much for you to make significant money with options. Okay. Any other stocks we should look at? Not for options, just to look at normally. What's MPW? That got really beaten up. It's still coming down because of Stewart. That's the tenor, right? Stewart. Yeah, Stewart is having trouble paying their rent. So MPW, and that's their biggest tenant. So if Stewart can't pay the rent, they may have to take some losses and possibly not pay dividends. But it's not its all-time low, but it's getting there, right? What was it trading back in 2008? It's back to it's below its IPO price. It did get low in 2008, but it's I think just in January it was at its all-time low, $3. It's so hard to time it because I wish they got rid of these bars at the bottom. It always. Does anybody know how to get rid of the volume bars at the bottom? Because it makes it harder to read the chart. Okay, so it's $20 2 years ago. When was the big dip? I guess it was in July. So yeah, August was a big dip when they announced Stewart was not a. Alex, was it? I feel like no matter how much I break things down, like options, it's still hard to convey the message. But you should definitely buy call options. Don't do covered calls unless just buy some call options. Spend $100. It's a good way to learn it. So in July, so it's nearly a year since they announced that Stewart was having. If you were really good at reading through their reports or reading through their press releases, you would have seen they talked about Stewart, but like they talk about a lot of things, so it's hard to know when to. When to buy it, but like it was $10 in July 2023, and then they had a real big dip here, down to below 7. And I thought that was a good time to buy it below 7. And then it just kept coming down. See, it came here and then it had a little jump up. This must have been another earnings release. It went from 5. It's so hard to figure out when to buy it because it seemed like a great deal at 5. Then it went from 5 to below 4. I mean, I guess if you had a crystal ball, I guess anything below 4 was probably a great time to buy it. I wish I had balls of steel, and I could have done that. Because I don't think it's going to go below 4 again. It ended up going to almost 6, and now it's settling at 5. And RSI is 53, so that's kind of around 30 is a great time to buy it. 70 is when you sell it, so it's kind of in between. A lot of buying activity here on May 13th and 14th. But this is like that game on The Price is Right when they go higher, lower. Like what's his name? Drew Carey turns over a king of diamonds, and the person has to say higher or lower, and pretty much everybody says lower because what are the odds that king or ace comes out? Pretty low. And then a jack. The next card's a jack, and they go higher, lower, and then it's a 6. So it just you play the odds, right? And you don't want a card like a 6, 7, 8 because it's kind of close to 50-50. You want like a 2 or 3, a king or ace. So I think it's like at a 5. Ironically, a 5. So would you go higher or lower if I turned over a 5 of diamonds? Would you say higher or lower? You would say higher. So I think they're at a 5 right now. When it hit sub $4 down to $3, I think it was like a 2. If you turn over a 2, why does it do that? two of clubs, it's like a 90% chance it's going to be higher than a two of clubs, right? The wheel deal, what is that? I spin the wheel like a virtual wheel. But what do you get? What do you get on the wheel? So I wish I picked it up when it was a two of clubs, but now it's still not that high. It's still it's probably a good value. The thing is, if you buy it, like if you buy it at 5, for instance, and it goes to 6, do you sell it? Probably not. What if it goes to 7 or 8? The thing is, we usually don't sell. And then if it ends up coming down to like 2, we lost all those gains. So that's the thing when you buy these stocks is like, when do you buy? When do you sell? It's hard to figure out the right point. It's just easier to buy a good company and not sell it. Even if it goes down, you just wait it out. But if I spin a wheel, like what do you win? You win options. I send you I send you an option contract, or like, what is it? Oh, do I send you like a gift card? I'll check it out. Do you ever look at conversations on Yahoo Finance? Sometimes I get some info that I didn't read about. And usually if somebody makes a comment, I won't like buy or sell based on someone's comment, but it gives me information. Then I can look into that, what they say. I go, oh, I didn't realize that happened at the company. I said, Bradley, thanks for being such an angel and looking out for everyone with absolutely no motive. June 2028 bonds are yielding 12%. Why would I be foolish enough to buy the stock when you could make 12% on the bonds? That's interesting. I guess MPW sells bonds, and that's the yield, the interest rate on the bonds. I don't even know. How do you buy the bonds? I guess you need to contact your broker. What's their yield? What's the dividend? 15%. That's the thing that you benefit from, because if you buy the stock for 5, and this, let's just say it goes down to 4, you still get your a really big dividend, assuming they keep it. You have to contact your broker. I don't know. I don't. Like if you're E-Trade or Robinhood, you have to email or call your brokerage and ask them. I think I have. Let me open my E-Trade. I'm in my E-Trade account. You can't see it, but warrants are long dated options, but you have to buy them directly from the company. You can't buy warrants in open market. I've never owned a warrant before. Has anybody owned a warrant before? Okay. So you gotta have to go to your brokerage account, and not all brokers sell bonds. Like probably Robinhood probably wouldn't sell bonds, but okay. So I'll type the ticker. MPW. Yeah, let's do the wheel strategy. Yeah, you have to try to buy some out of the money options. Just spend a couple $100. You're not going to learn by watching YouTube videos, and you can see how the option moves in price. Because if you bought like if a stock was trading at $100, for instance, and you bought, and you bought 150 call options, and let's just say it's just short dated, so you had till 6:15. Okay, you had till 6:15:24. And let's just say it cost you, I don't know, like you got to pay $500 premium for the option. If say next week, today is like May 20 something. So you bought it on Monday. You pay $500 for $150 strike. And let's just say next week, the price of the call. This is how most people trade options. This is how I trade options. Say the stock goes up a lot. It goes from 100 to 140. Well, you're still out of the money. But I would just sell the option, because the option probably went up a lot. It went from 500 and it's probably now like 1,200, like, because it's getting pretty close to the strike. So you can just sell the option contract for 1,200, and you made $700 without even the stock even hitting your target. That's how most people trade options. Like I never bought the shares. I once got shares taken from me, but I've never purchased the shares when I bought an option. But that's generally how you do it. But let's look at this. I'll be right back. Bathroom. The thing is, if you bought these $150 call options for 500 and the stock went up to 140, so it's getting close to your strike price, would you sell the contracts, or would you wait to see if it goes up a lot more? I had a bond in my account. It expired last year. So I look at these rates. Because if it was like 2017 and these rates were out there, like a US Treasury bond yielding over 5%, I would have taken like $1 million loan, because I had a 3% mortgage on my home, and it was even lower at some points too. I know some people who got like 2.8%. So I would have taken like as much debt as I could. I wouldn't have gotten it 3% if with these rates. But if I somehow knew, money markets were going to be like 5, 6, 7%, I would have taken out all the debt in the world, and lock in a guaranteed 5%. Because if you think about it, like, if you took $100 in debt at 3%, and then money market was yielding 5%. So you have to pay $3 a year on the debt. And you get a $5, a guarantee $5. So you make, oh no, it's even more. You get a 67% return on your money. You lay out $3 to get $5. So I would just do this all day. I would be just taking millions and millions of debt. So you're getting your, obviously if money market was 5%, no bank in the world would be lending at 3%. Every bank would be lending at like 12%, 15%, because a mortgage is a low rate. Like if I took a personal loan, I couldn't, even when rates were really, really low, even a personal loan would still be like 6% at the least. Or I can, but a mortgage, you can get a low rate because you have the asset. But if I could predict the future, yeah, I would have taken out all the debt I can on my home if I knew money markets were going to be this high. Then I would have just put it. Obviously, if I could predict the future, I would just buy NVIDIA. I'm talking about government, the U.S. Treasury are yielding. This is 100%. Nothing is 100% guaranteed, but U.S. Treasury is the closest thing you can get. There was a time in the 80s when U.S. Treasury bonds were yielding like 15%. maybe not 15%, maybe like 12, 13%. Look at that. The Fed funds rate was over 18%. So if you somehow could have gotten a lot of money scrounged up and put it into a 30-year CD, you could have been like a billionaire, because 18% annual, every year, and it just keeps compounding. So I'll show you, like, so let's say the rate is, let's do 15%. What the hell? What's going on? I'm doing it backwards. Okay. 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 So let's say you invested. I mean, you have to obviously get your money, get your hands on so much money, but let's say you somehow got your hands on $1 million back in like 1980, a guaranteed 15% return. So if you somehow you went back in a time machine, you put $1 million into money markets, even if you did it for 10 years, in 10 years, you could triple your money. Imagine tripling your money with 100% guarantee. And if you did it for 20 years, you could have turned 1 million to 15 million. 30 years, 65 million. And 40 years, you could have, in 50 years, you could have been a billionaire by investing in US Treasuries. That's like the people who put money into Berkshire Hathaway when it first started. They have hundreds of millions of dollars just by putting in like 50,000. But $1 million is a lot of money. Let's say you only got 100,000. You could turn 100,000 to 100 million. Compounding. It's crazy. It went from like north of 18% to pretty much zero for like 7-8 years. What's better, weekly or monthly options? You want to do options a few months out. You don't want to do an option that's expiring next month, because it is cheap. The premium is really cheap. So you can get options at a low price, but you just don't have time. You don't want to buy options that expire next week. You just don't have enough time till the option goes up. Because even if you get it right, even if you predict a stock price perfectly, but you're off by a few days, it expires worthless. Okay, so let's go back to bonds. So you have to go to your broker. E-Trade, I just hit trading, and then I went to bonds and CDs, and then it just asked you a question to confirm you understand the risks. Then I just hit OK. But we can look at more munis that tend to be pretty low risk, and you get tax deduction. Like if you buy munis in your state, like California muni bonds, you don't have to pay state taxes. And certain munis, you don't have to pay federal taxes either. Does anybody buy bonds here? Let me know if there's any bonds, because I don't really look at it, but I actually used to be a bond trader in New York City. Corporate bonds, not like U.S. Treasuries. But look how tight the spread is between the BBB and AAA. It almost makes it's no benefit to even buy BBBs. It's not even that much more than AAAs. When rates were a lot lower, you probably would see more of a spread between the two. And look at 30-year bonds. BBB is 6.2%, but 9-month is only 6%. It's that inverted yield curve. You're supposed to get, by locking your money away for 30 years, you're supposed to receive a greater return, but it's not even that much greater. Why would they do that? Why would they only offer 6.2%? It's because of they don't want to give you 6.2% for 30 years. Because what happens when a bank offers you a 30-year bond? They have to pay you. They can't just say, oh, rates are now, like the Fed funds rate. $5.33. This is a good example. So the reason you don't get, like, is this why people I over explain? Is that why nobody watches? Because I can't get through one topic without over explaining every single detail. This is why you're not getting, the spread is so tight. So 1 year BBB. Let's do the AAA. It's crazy. It's inverted. You don't see this. 5.3%. And look at the 30-year AAA. It's lower. It's lower than a 1 year. So why would anybody, if you're locking your money away for 30 years, you should get like a 6%, right? It should be higher, the 30-year, than the 1 year. Because if it's lower, which it is, in theory, you can buy the 1 year, just keep rolling the 1 year. The problem is, like right now, rates are probably here. Fed funds rate is, I think, 5.3%. This is 6, right? It's right here. So if the bank offers you a 30-year guaranteed fixed 5.2%, the reason they're not offering 6%, which is what they should offer, is because if rates come down back to even come down to like 2%, they don't have to go to 0, 2%. The banks could lose a lot of money because they have to pay you the 5.2%, even though rates are so low. Like if the Fed funds rate is 3%, that means the bank gets money at 3%, then has to pay you 5.2%. It's madness when this happens. The inverted yield curve. What's the better? Yeah, I didn't really understand what you meant. What's better by weekly or monthly options? There's no, I don't know. There's no weekly or monthly options. It's just the expiration date. The expiration date may be a week away, or a month away, or 6 months away. Let's see. They have high yield. High yield means junk bonds below BBB. So you have 19% CD bonds, which is really bad. It's usually close to bankruptcy. Buy some muni bonds from Detroit. Okay, here's corporate bonds. Okay, here's what that guy was talking about. MBIA. I used to work at a company similar to MBIA. So corporations, look at it, Lumen, 25%. That's a telecom company who uses old software. Tuan fam. Yeah, I think there's a big concern with CREs, commercial real estate. A lot of defaults coming soon. So you might be able to get really high yields on CMBS, but there's a good amount of risk that they may default. I don't understand this because it only shows like 10. Isn't there like a screen? Like, shouldn't there be like thousands of bonds? I guess I'm just not used to this section. 8% no tax. I don't think so. I don't think that's possible. Because munis pay lower interest. So if you buy like a corporate bond, you may get 5% interest, right? And munis 4% interest, but you don't pay as much in taxes. So it ends up being the same after you take into account taxes. Obviously, depending on your tax rate and a lot of things, but munis tend to be a lot lower. I never really buy bonds. Maybe I should. Apple. Issuer Apple Inc. I don't understand why nothing comes up. Maybe I'm in the wrong section. Maturity. Okay, let's do it. Let's do. There's nothing 20%. I don't understand that. Oh, I gotta go high yield. But there's 20. I thought. Let's do 10%. Nothing 10% either. There's only 32 bonds that I could buy. You need inflation-proof bonds. Tips, right? Am I in 7.5% Prospect Cap Corp? TD Bank bonds. Corporate. Okay, so the single A has the highest. Oh, that's because it's investment grade. You buy bonds? I mean, nothing wrong with bonds. I just usually don't buy it. Corporate, muni CDs, treasury auctions. Yield to worst. Okay, here we go. I guess I thought we saw a 20% rate on the other one. Okay, well, any thoughts on gas pipeline pullback recently? What do you mean? Oh, you mean gas prices have come down? Oh, what do you mean gas pipeline pullback? Like the midstreams? Okay, so the midstream stocks. Okay. Yeah, I mean, I own ET, Energy Transfer, so yeah, ET exactly. So I'm up 100% or more with that. But I forgot to tell you guys. No, I think they're really good stocks. There's a lot of. They're much less risky because companies are always looking to transport oil from upstream to downstream. So these companies are kind of locked into these contracts, and as you know, oil, we can't live without it. So I think there's definitely volatility because they do move around with the price of oil. When oil goes up a lot or down a lot, so do these stocks, which I think people don't realize. It pretty much moves the price of oil. Even if you watch other YouTube channels, they always say, "Oh, they're not dependent on oil." But I'll show you. So look in the past 5 years, the green line is the price of Brent crude, so oil prices. Let's okay, that's fine. I don't know what. I was looking for West Texas Intermediate. That's the. Oh, maybe it's called crude oil futures. Okay, there you go, crude oil. So the black line is crude oil. That's kind of like that's what we track. U.S. companies buy crude oil, or at least the price of crude oil is tracked for WTI, but non-U.S. companies, most non-U.S. companies are Brent crude. So they pretty much move together. You can see they're almost identical. But the two biggest midstream companies are, or in the U.S., the two biggest is Enterprise, which is EPD, the red line, and the blue line is Energy Transfer. You can see they all move together into COVID. You can see the price of oil, Brent crude in West Texas, did go up a lot more than these stocks did. But now they're pretty much tracking each other, right? And the only reason they don't track each other perfectly is because midstream companies pay dividends. So they would go up as much as the oil prices. But since they pay dividends, the stock won't go up nearly as much. So they pretty much track the price of oil right there. I mean, there's no denying that. And I met with my accountant a few days ago, and I wanted to ask about the taxes for MLPs. And she said most of the taxes you pay are ordinary income tax. I mean, are long-term capital gains. She says, I thought most of the taxes I paid were the higher tax rate, the ordinary taxes. They're like the 30% tax rate or whatever your income is. But whenever I receive dividends, they call it distributions for MLPs. I don't pay taxes on the distributions. It just reduces my cost basis. So my original cost basis when I bought ET was $40,000, and every time I receive distributions, it brings it down. So I actually didn't even pay taxes on most of the distributions because now my cost basis is $31,000, and in like 3-4 years my cost basis will be zero, and then I'll pay taxes, but only on the long-term capital gains, the lower tax rate. You were cutting a tree down? And I talked to her. She knows what she's talking about. And I said, I always thought MLPs, you pay the higher tax rate. You do pay the higher tax rate. For some reason, they did give me dividends of $700, and I had to pay ordinary income taxes on that. But a majority of my dividends, the $7,000, was just reducing my cost basis. Isn't that exciting? But I don't think it's like that with REITs, because I should buy a REIT so I can figure this out for sure. But I think most of the dividends you receive on a REIT are ordinary dividends. But for MLP, since you're a partner, that almost seems too good to be true, right? I'm getting like an 8-9% dividend, and my taxes are low. Actually, I'm not even paying any taxes. My cost basis is bringing down my cost basis. Of course, when I sell the stock, like if I sold it today, I think it's like I don't know how much. I think it's like I paid $40,000. I think it's like $70,000. The shares. No, it's yeah. So how much is ET? 1544. Okay, it's actually more. It's 89,000. Okay, so I paid 40, and then my updated cost basis is is 31,375. So that's my cost basis. And if I sold it today for 89, I would have a $58,000 profit. And then I pay long term is 20%, I believe. So then I would have to pay 11,000 in taxes. But at least I don't have to pay the higher tax rate, ordinary taxes. REITs is struggling right now, though, as a whole sector, because of high rates. Wonder what is the inflection point, considering some triple net lease REITs are interesting, but midstreams are more attractive. They're so much more attractive, midstreams. The thing is with any commodity stock, timing is so important, much more important than like a Microsoft, because if you time it wrong, I get it, you get your dividend, but like this is the stock way back in 2006 when they started trading. So obviously, if you bought it in the early years, you could have had a nice dividend. But say you bought it in 2015. I don't think Brent Crew goes back that far. Okay. Um, 2006. Come on. So you can see this is the price of oil since like 2004. And this is the price of ET. So it's hard to tell exactly, but you could see the dip from COVID, or when oil became negative. You could see the dip here. That was the lowest oil ever got. And then there was this, there was a huge, oil prices got really, really high in 2015, the beginning of 2015. There was a crash at the end of 2015, beginning of 2016. So if you bought ET north of 20, it's just like it's already been like almost 10 years since it's north of 20, and it's still not there yet. So yeah, it's getting up there. So I mean, I was lucky. I got it around 850 a couple of years ago. But yeah, if you buy it like 25, 30, like you almost never get back to where you invested in. You have to get it a good price. And if you don't, it's not a good price, you just have to wait. Because it's not like a regular company. It doesn't go up indefinitely. Like Microsoft just goes up forever, pretty much, as long as they're in business. Oil just goes kind of up and down, up and down. I mean, the reason the reason they become an MLP is to avoid double taxation. They don't have to pay corporate income tax. They can pass it all on to the investor. That's why they pay high dividends. But they have to 90% of profits have to be paid out as dividends to the MLP holders. So it's hard to scale and grow your business when you can only retain 10% of your profits. So that's why they take on so much debt. That's why like Meta and Amazon, most technology companies don't pay a dividend until like Meta finally paid a dividend, but some don't pay a dividend for like 20 years because they want to retain all the money to grow. You can't do that with REITs and MLPs. You can't retain all the money because you have to legally pay out 90% of your profits. So it seems great, like to be a REIT, because then you can offer these amazing dividends and you get all these investors. But it's hard to buy new properties and grow your business because it's just really about giving it all back, or most of it back. So that's pretty much the reason they switch. Because especially if you're not generating that much profit or even losing money, it doesn't benefit you to be a MLP because you could eventually go bankrupt. Because you need the money to pay your debts and your bills. You can't afford to pay big dividends. Okay. But yeah, my throat is getting a little scratchy, so I can't really probably cut it off here. Too much talking. But okay, well, I don't think the option thing went as well as I thought it would, but it's out there. So if you want to file, keep you can email me if you want that option file. Okay. LNG, liquefied natural gas, next on the agenda. Okay, I'll see you later. Thanks for commenting and joining.